In this lesson, we're going to look at really important accounting terms: assets, liabilities, equity, revenue, and expenses. Let's start with assets. These are things the business owns, like cash in the bank, property, computers, or equipment. Basically, anything that has value and helps the business run. Next, we have liabilities. These are the things the business owes. Money that needs to be paid back. It could be loans, unpaid bills, or credit card balances. Capital, also called equity, is the owner's stake in the business. It shows how much of the business the owner actually owns after adding what they put in and subtracting what they take out. There are two main parts. First, owner's investment. This is the money or assets the owner puts into the business to get it started or help it grow. And second, profits kept in the business. When the business earns a profit and the owner leaves some of it in the business instead of taking it out, that increases equity. Then we come to revenue. This is money coming into the business, usually from selling goods or providing services. In the UK, sales, revenue and turnover all refer to the money a business earns from its normal trading activities. In accounting, we usually use the word revenue. And finally, expenses. These are the costs of running the business. Things like rent, utilities, cleaning, insurance, staff wages and salaries, and so on. By keeping track of these categories, what the business owns, owes, earns, and spends, we can clearly see how the business is doing.